Hey guys, what's up? Welcome to another episode with me, Shashank Udupa, and today on public demand, because a lot of you guys kept saying Shashank start reviewing IPOs and a few guys in the comments as well. So I thought let's quickly review one IPO that looks very interesting and is in a futuristic space. Now, obviously, let me just show you the grow dashboard over here for IPOs. There are many IPOs coming out. For example, there is Vidya Wires coming out, oversubscribed by 7.34, Aquis 9.75, and Meesho 6.1. Now, I'm going to review Aquis because Meesho, I think, is little overhyped and overvalued at the same time. And all of these guys come for a very heavy exit. Aquis, on the other hand, is in the aerospace industry. So I thought that not just let's look at the company, but let's also look at the peers of this company and understand what is happening in this aerospace department. And aerospace as a sector is poised to do well over the next 10 to 15 years. But I know a lot of people have hyped it up by saying it is the, massive theme. It is nothing like that. It is a very long-term theme that will play out over a period of time, 10, 15 years, natural growth. It is not an explosive growth kind of a theme like, let's say, or power. So don't get too overexcited when you listen to this. So let's quickly get into the video. Also, guys, for all the people who don't know, we have started moving our YouTube community to Telegram. This is main reason why I've done that is because now I can give more and more analysis out here on the YouTube community. I couldn't do that. For example, we gave yesterday the Meesho IPO review. I mean, we have said avoid only. We give daily market updates there. We give one pages of Meesho IPO and the company's analysis. So if you want regular updates about the market, we have shifted it from YouTube to Telegram, and we've reduced the cost by almost 40%. On YouTube, it was 199 rupees a month. Here it is 149 rupees a month. So if you guys are interested, you can definitely come in and have a look at this, right? Chalo, let's quickly get into Aquis. Now, this is a beautiful report by SBI Securities. So I thought let's quickly go through this itself because a lot of information is there in this. Now, Aquis is basically a precision component manufacturing company that is operating in a single special economic zone, SEZ zones as they call it, that gets some perks. And they are a fully vertically integrated company that works in the aerospace segment. And as you know, aerospace is taking a lot of trend in the market and everyone is talking about this. In fact, who was that? Ravi Dharamshi's company ValueQuest had actually created a very beautiful report on the entire aerospace industry and why India will now get a lot of benefit from this. Just to give you guys a backstory why this is the case, because Airbus and Boeing are two major companies, and after COVID, they realized that, a massive supply chain problem happened after COVID. In fact, many European companies where they used to get precision parts from shut down due to COVID because, they couldn't sustain their entire business. And that is the time they realized that, we to have flight orders, Airbus and Boeing from all over the world, they get orders. They have 10-year backlog of orders. That's when they realized that we can't depend only on European countries. Let us start going to other countries and building a backup. And then one of that countries was India, and they've noticed that we've worked with India before, so let us go into this. And that is why you see so many different companies in the market coming here. I will talk about that in this video as well. So as you know, the IPO is currently open. Again, please note, I am not against or for the IPO. I never apply for IPOs. I only buy it post IPO if I feel the company is good once it's fallen. So I never buy any IPO, right? I don't like it at all. And I can't put my volume that I want to buy. So 15,000 mein kuch nahi hone wala hai. So I don't buy it. Now, what does this company do? This company offers a diverse product portfolio which includes components of engine systems, landing systems, cargo, interior structures. Apart from this, they also work in consumer electronics space, plastic toys, and consumer durables, where they work with a company called Wonder Chef. Okay. Now, coming to the issue size, right? Offered for sale, which is the money. The fresh issue is 670 crores. Offered for sale is 251 crores. This is the money that will not go to them. It is an outside exit. 670 crores is a company that goes inside the exit. So it's a good news that 670 crores is going back into the company. Post market cap issue will be 8,300 crores on the upper price band if it lists at the main thing, right? So key highlights: vertically integrated precision manufacturing thing. So they have a 12 lakh square feet facility for the aerospace segment located in Belgavi in the SEZ zone, 3 lakh square feet of consumer electronics and consumer durables. And we'll go to the financials and I'll show you a little bit more in that as well, right? Now, if you talk about the aerospace industry, first of all, let me highlight a few things here. Number one, it is very difficult to be in this industry. Okay. Why? It's not like tomorrow anyone can get up and come into an aerospace industry. You need a lot of certifications because the tools that go into an aeroplane are so important that not a normal person cannot do it, right? So you need to be specialized, you need to be good with it. And you have to get a lot of certification, which India is doing really hard and working really hard on these certifications. And once you become a customer of, say, Airbus or Boeing, they usually don't change their vendors for a very long period of time. In fact, after COVID, when they realized that European markets were struggling, Airbus and Boeing started funding their vendors and even giving them special benefits, taking equity in their companies, so as to, ensure that this doesn't happen again in the future, right? So this is a company that is currently in precision component manufacturing, and they also have two dedicated component manufacturing facilities for the aerospace segment in France and USA. So they have it one in France and one in USA as well, which is very commendable, honestly, right? Because getting into this industry is very difficult. Now, over the years, focus on higher value added products. Now, usually when you look at aerospace manufacturing or precision manufacturing, this is high margin business. Usually they are high margin business if you're selling the right tools to them, obviously, because it's so expensive and it's so unique. It is a high margin business, high gross margin, high EBITDA margin business, but we'll look at the financials later. Now, over the years, AL has strategically prioritized selective outsourcing of lower value activities such as 3-axle, 4-axle to subcontractors. So now what they're saying is, earlier, now they want to move into specialized stuff, high-end alloys like titanium alloys for aerospace client, because they want the higher margin business coming into the picture, right? Till now, they are not playing in the higher margin business. As of September 2025, the company produced 5,000 products with aerospace segment under a variety of manufacturing and assembly programs for aerospace customers, which is your single aisle such as A220, A320, 737, A330, 350, B767, 777, and all of them, right? So basically, they are in multiple areas. And they've also done some acquisitions. For example, in 2015, they acquired T&K Machine, a company that produces machine parts and assemblies for the aerospace industries. And this helped them get into the North American market. In 2016, they acquired a company called the Sira Group in France, which provided, again, machining, assembly, fabrication, and testing capabilities. And this made Aquis go and work with Europe-based clients such as Safran and Collins, which are one of the biggest players in this space. Now, coming to the proceeds of the IPO, the money that they were raising, 433 crores of what they're raising is going into repayment of borrowings, which is a very good sign. That means this company has a lot of borrowings, and if they repay that borrowings, automatically in the next quarter's profit and loss statement, the interest component will go down and the profit after tax will go up, showing a much better benefit. 64 crores will go into capex. Basically, this entire IPO is to reduce their debt, okay, which is a good sign. It's not a bad sign at all. Pre-issue, the promoter had 64%. After the issue, will have 59%. So very less dilution by the promoter and promoter group, right? Which is a good sign. Who are the people exiting? Not any big names are not there, but these are the people that are currently exiting right now. Now coming to the financials of this company. Look at this. Very carefully look at this, okay? In FY23, they had 800 crores in revenue. FY24, they had 965 crores in revenue and then 924 crores. So there has been a dip in revenue, even though it has grown from 812 to 924. Last year to this year, there has been a dip in revenue. This year, they have hit 537. So there's a very high chance they might go about 1,000 crores in this year's revenue. EBITDA positive, 35 crores, 123 crores and 73 crores. So here you can see that the margin also has dipped quite a lot. The EBITDA margin from 12% has gone down to 8%, right? But after EBITDA, you will see the PAT, which is profit after tax, taking a massive hit, which is negative. These are two reasons why this can be negative. One is interest component and one is depreciation. So we will understand when we go further below what's the story here. Capacity utilization is currently at 41. Earlier it was at 44 and now it is at 41. And in the first half it is at 43, right? And their EBITDA margin is currently at approximately 10%, which has actually gone up. In FY25 it was less than 10%. As you can see, it was 8. Now it is at 10.4. So you can see some cyclicality in this. It is not very straightforward, but we will have to check a little bit more into that. Risk factors, high dependency on the aerospace segment because almost 88 to 89% of the revenue is coming from this department itself. Customer contribution, company's top 10 customers contribute to 83%. But this I would not say is a bad thing. I'll tell you why. Because in the space of aerospace segment, there are very few customers you can play with, and most of it is concentrated to the big players. And I'll show you who their customers are also, right? That is how it is. Growth strategies will ignore. Yeah, product portfolio you can see. Structures, basically bracket, corner fitting, cable quadrant, and I'll show you some images of their products as well. Gearbox, bracket, floor load, interiors, cargo, power distribution, unit array, side panel, all of this is what they make. Consumer electronics, components for portable computers, smart devices, outdoor games, darts, right? And this is a new business, less than around 10% of their entire revenue right now. So this is the aerospace segment. What do they actually do? So you can see the parts here. These are the precision tools they actually make, and they use some in turbines, they use some inside the aircraft, which is again very, very, very interesting, because these are supposed to be high value products, but you can see now that it is not high value. If you see the revenue does not seem like it's high value, right? It's only 10% EBITDA margin. Ideally, it should be more. Coming to consumer segment, this is what they're doing. As I told you, they work with Wonder Chef, they work with Hasbro for the toy space. So they make some tools and stuff, product portfolio components for plastic toys, right? Manufacturing, they have 1, 2, 3, 4, 5 almost places. So there is 3 in Bangalore, Karnataka, and 1 in France and 1 in Paris, in Texas, right? Now, coming to the customers, as I told you, this customer acquisition, which you said, right, top 10 customers have most of the thing, is obviously by default, because you're dealing with Boeing, you're dealing with Airbus, who are the 2 major components in the world, and Safran is number 3, right? So you have Airbus, Safran, and Boeing. But the beauty of this part is, look at this number of years of association, 15, 9, 9. And I told you, in this space, people don't change their customers, right? They don't change the vendors, because once Airbus knows that this guy is giving me very good parts, I am not going to change it suddenly overnight. So that is the main game over here. Coming to revenue and EBITDA split, as you can see here, in FY25, almost 90% of the revenue was aerospace. 100 crores is from the consumer segment. And if you look at the consumer segment, it's actually going down from 227, 208, 100. The only thing that's going up is aerospace, which is 585, 757, and 825. Even now, in this quarter, the consumer segment has had a massive degrowth of almost 40%. Not 40%, let's say 120. It's pretty much the same because this is half yearly. But the consumer segment is not something that is growing aggressively, right? The only thing that is growing aggressively is the aerospace segment. And aerospace segment is something that should grow more aggressively. And you can see here the margin now has reached 24%, and they had a lower EBITDA margin because of the consumer space. So I don't know why they're keeping the consumer space honestly right now, because it is creating a negative margin impact on their entire portfolio. If they were purely into aerospace, their margin would be around 24% EBITDA, which would be crazy, but right now they're not. Coming to revenue split by geography, you will see that USA and France, this is because of Airbus and Safran, are currently major portion of their revenue. Everything else is very small. Coming down. Yes, industry is going to grow. As I told you, the aerospace industry is very interesting. It is going to grow. And in aerospace, there is multiple types of aerospace. One is creating these precision tools. One is maintenance activities, MROs. A lot of those things are coming into the picture, right? Now, this is very important. Let's come here. If you look at the FY25 revenue statement, EBITDA, I told you, was 74. EBITDA margin is 8. Sadly, it has fallen down mainly because of your degrowth in the consumer space. The EBITDA margin is bad. Gross margin has remained pretty much the same. In fact, it's actually improved. Employee cost is pretty much okay. Operating cost is okay. So EBITDA is down a little bit. Now, interest expense over here is 59 and depreciation is around 104. So major component depreciation, which is a non-cash expense, is over here at 104. But 59 is what we see with the interest, which I want to see how much debt is there, because if that debt goes away, this 59 straight away becomes much better for the company, and there is a possibility of good revenue coming into it, right? Because 74 EBITDA plus another income of 35 plus 60 will go away. So almost 160 crores would be profit before EBITDA, and then you have the EBITDA of 100. So that way, it will slowly keep going down. There is a chance of it becoming actually PAT positive immediately after the IPO if the borrowings are netted off. So let's look at the borrowings right now. Long-term debt, as you can see here, 437, and right now it is 534. So almost 80% of the long-term debt should be going away. Most of it is lease liabilities, not long-term debt, but most of the debt should be going away because of the IPO, which should make the company directly profitable as soon as it gets over, right? The company is positive on cash flow from operations. Investing activity, it is growing, so it is doing more and more. Cash flow from financing activities, 166. That means they're selling something on the other end, funding it with debt or funding it with something else. Hence, the free cash flow is currently negative, right? No point looking at the ratios because the ratios are skewed off mainly because of the debt to equity problem that they have. Now, this is very important. This is where I come to as the main part of this entire learnings, right? Now, if you look at this, Aquis is here sitting at 925 crores of sales with 74 EBITDA, 8% EBITDA margin, and it has a market cap of 8,300 crores. You have Unimech, which is another company. I'm looking at it from a 243 crores sales, which is 1/4 the sales, right? But the EBITDA of this, as you can see, is 92 compared to say EBITDA of 74. So you look at the margins that it's playing on here is much better. The net profit is minus 54. The net profit is 77. Right. So this is what I'm saying. The higher margin products are very important here to look at because this is where the game is. Right. So this has a very good EBITDA margin and this is supposed to be in the 20-25% range. Right. Because they do have a 20-25% range of EBITDA in their aerospace industry. The consumer industry is making it go down. Right. If they only played on 925, maybe their sales would go down by 100 crores, 825 crores of sales. But at least they would have 150-160 crores of EBITDA playing it. With no debt, they would suddenly become 120 crores or 100 crores PAT positive, which would be very beautiful. Azad Engineering 457. Again here, very good EBITDA numbers, very good PAT numbers. Very good EBITDA numbers, very good PAT numbers. If you see the EBITDA margin, you'll understand. 35%, 37%. Remember I told you that in the aerospace industry, margins will usually be high because these are specialized services that you give. Both Unimech and Azad are sitting at 35-37% EBITDA margin and this guy is sitting at 8. Doesn't mean it's bad. It can be an opportunity because this is also called as operating leverage playing out. This, as soon as your market, if they remove their consumer space, this 8% EBITDA can go directly to 2025, right? It can jump to 2025, which is not a bad sign. PTC Industries, 24% EBITDA margin. Dynamatic, I don't know about this company. It doesn't seem like it is exactly in that space, but I don't know, so I don't want to comment on it. Everyone else follows a similar mimicking structure, right? All of their P ratios are insane. Even the EV EBITDA ratios are insane, very overvalued. Even this company is coming in the same thing, but I cannot judge the P ratio because the profit is not there in this company right now. This is sitting at 8 times EV to sales. This is 22, 20. Everyone's overvalued in this space because there is too much FOMO in this space right now. And that is why it is overvalued. But I don't honestly believe. Now, just summing it up, right? This is the company which is getting 89% from the aerospace. It is into machining, forging and assembly, works out of a SEZ zone in India. The top tier 1 suppliers are Airbus, Boeing, Safran, Collins and Hasbro. IPOs going out right now. High client customer concentration, but I already told you why that is the case. It is in the profitable growing aerospace business, which is 24% EBITDA, but the bad sign is the consumer business, right? IPO proceeds to fuel growth and reduce debt. So once this reduces the debt, the net profit will suddenly become very aggressively good. And that is what even we are looking at, right? Now, again, if you guys ask me the question, Shashank, would you apply in this IPO or not? Even if I was, because I don't apply in IPOs, but for the way I see it, I only look at it from a fundamental standpoint, not from an IPO listing gain standpoint. That I don't know what will happen, but I would wait for that debt to get cleared. I would wait for the IPO to get over, let it fall down or let it go up, let everything get over. I need more clarity in the consumer space. The minute they announce that either the consumer space is profitable or it is away from the game, even if they put it off into some other subsidiary or demerge it out, then this business becomes very profitable. But then when I have other companies in the space like Unimech or Azad or PTC, I would rather look at them who are mostly focusing on aerospace itself, right? Like Unimech is a very high aerospace industry company. Now, again, a very big disclaimer to all of you guys. I don't hold any companies in what I've shown you today because I'm an RA. I'm supposed to give that disclaimer. So as of today, I don't even hold any of these companies, nor have I bought these companies in the last 30 days. Okay. So I hope you guys enjoyed this video. I hope you guys like this video. And if you want more updates about markets, as I said, we have a Telegram group where I keep giving constant updates. You can come and join it if you want at 149 rupees a month. This is me, Shashank Udupa, signing off. Take care. See you guys. Bye-bye.